We've had relationships with founders for 10 years. I mean, that's longer than a lot of marriages nowadays.
Healthcare, food agri, skilling, logistics, and that became the basis of our whole Fund 1 strategy, and it's worked out pretty well.
We invested in Jai Kisan a couple of months before COVID, and we were worried that will food supply chain get impacted, and the way things were managed, everything was seamlessly working. The power of aggregation really is the defining theme for us.
Whenever I meet a company and a founder, especially after we have invested, I know I don't know. You can never know more than the founder.
Venture is a risk buying business. We are buying into risk.
Bala, Rahul, very happy to be talking to you, and a very significant development for all of us in the startup ecosystem, in the country, in the entrepreneurship ecosystem, because with Arkam Ventures, what both of you have done is, we talk about Bharat, we talk about Middle India, but to my knowledge, you're the first focused fund for Middle India, and you've invested in entrepreneurs and for entrepreneurs of Middle India. And of course, we'll discuss why we are calling Middle India and why it is important. But your first fund of $106 million was raised in 2020 during the time of COVID. And now you're launching your second fund to invest in Middle India. So welcome to both of you, and please tell us about your thesis of investing in Middle India.
The Middle India thesis is that when we started the fund, both Rahul and I, before it became very popular, believed that the smartest founders were on to something, which is we want to invest in the deepest markets in India, and these markets were really the next 400, 500 million Indians below the top of the pyramid, but bring digital solutions that has solved historical challenges in terms of acquiring customers, in terms of servicing customers, in terms of risk of doing business with these customers. And that was the whole thesis of trying to go after markets that matter to these consumers, which is financial services, healthcare, food agri, skilling, logistics, and that became the basis of our whole Fund 1 strategy, and has worked out pretty well.
India also has developed its industries like most developed nations, which is catering to the people who can pay high value but result in low volume. They are high ticketed customers. But in India, the economic growth is going to go deeper, as we see. So it's next 400 million people is a lot of people. But they typically tend to buy very small ticket items, but very frequently. So industry structures can't cope with the new addition of these Middle India customers as they get added to the buying population. So we also felt that tech is the only way you can build scalable servicing model, because your marginal costs can't keep increasing the way that in the first 50 years of economic growth has happened. So we have to shift gears, we have to make it more tech centric. And tech, VC and Middle India combined was sounding like a great fund thesis.
Investors don't look at Middle India, and they will also not travel to Middle India. And over the last 10, 12, 14 years, I've also observed maybe there is some truth to that. And by just attacking that and going in that space, you are also breaking belief that we have that investors wahan invest nahi karenge. So tell me, how many trips have you taken to Middle India?
Especially I'll give you examples, right? So if you take somebody like, and the big difference for us is, right, Middle India doesn't necessarily have to be some village, somewhere in northeast of India, right? So if you just go to some of the manufacturing facilities in Tumkur, outside Bangalore, right? And if you go look at Tumkur, there are all these industrial clusters. And if you look at a company like ours, like Smart Staff, which all these years, without digitization, a small factory in Tumkur would essentially have blue-collar laborers or people coming in from an Orissa, coming in from a Bihar, and they would be working for a contractor without PF, without ESIC, without any visibility to anything.
Yeah.
What Smart Staff really does is, because 70%, 80% of 100 million manufacturing workers in India today have a smartphone, they have managed to bring these workers on the smartphone, where just like you check your phone in the morning, I've got a meeting with Arkam Ventures this morning at 12, they are able to check my shift is at 9, my shift is at 12, and also know the number one usage of the daily click on that app is actually how much PF and how much bonus have I earned this week, right? So these workers for the first time have the ability to also switch jobs, right?
Yeah.
So on the same platform, they might go to another factory very close by, which gives them maybe a 20% increment. So I think more and more the power of digital, which wasn't available before 2017 without digital rails in India, is trying to truly democratize the value of digital platforms in a way that it's useful, not just saying that you had to have an Aadhaar card, a eKYC, you had to have UPI and all that, but you're beginning to see layers and layers of how it's bringing about true change into people who are from, the 20,000 pin codes in India.
By the way, on our team, only Bala is from our metro. So we have people, I'm from Dehradun, we have people from Haridwar, Sikar, Surat. So, there's enough representation of Middle India. I think travel-wise, of course, MP is a great place. We've been there several times. Uttarakhand is quite frequent as well. So, yeah, we get our dose of what's going on. And in some places, we figure out that even UPI is not working. So that is, we can still see that, this adoption cycle is still happening very rapidly, but still a lot of room to go.
What's the potential of middle class India?
A decade back, large part of the problem was the problem of unbanked.
Yeah.
People were not even having bank accounts, and most of the, I would say, adoption was completely informal. This Middle India adoption is really informal to formal in these great numbers that we are talking about, 400 million people adopting formal standards of what is more quality and hence more accountable. So from financial products to healthcare, what you want to maintain is higher quality, sustaining that for a much greater number of customers. How do you continue to maintain that quality standard? The adoption cycle is moving from unbanked 10 years back to what is now going to be a slow adoption of multiple financial products, which would include protection, investment, savings, wealth. And from there, we'll see what we're seeing really unfold is this journey of this slow adoption. And in the process also, a lot of the Middle India is gaining income, earning more, livelihoods are kicking in, family wealth is accumulating. So even that curve is shifting to how do I get better quality healthcare or education or whatever, which is then available. But for somebody to provide it, it's going to be a challenging task to then make sure that they're addressing such a large base of customers. So I think that the real innovation that we're looking for is how do you provide high quality anything in these 5 essential buckets. So we are only focusing on the non-discretionary spend, which is 80-90% of the wallet share. So from healthcare, skilling, financial well-being, transportation, mobility, agri-food, these are 80-90% of essential things. During COVID, we didn't see anything declining. In fact, everything was up because the distress or the worry about livelihood or the worry about a job, all led people in Middle India to spend more on these essential activities. So we saw no disruption in food agri supply chain, for example. I mean, we invested in Jai Kisan a couple of months before COVID, and we were worried that will food supply chain get impacted, and the way things were managed, everything was seamlessly working. So we had absolutely predictable adoption of a lot of things, and it's just a secular curve upwards in terms of people adopting more, and it's all towards higher purchasing power as we speak gradually over the years and just accessing higher quality products and services.
What would be the number of middle India people?
400 million is our estimate. See, the UPI user base is about that much, of which we see that, if you remove the top 20, 50 million people from the top who are, using it more for convenience, and because now acceptability of UPI is so widespread, the bottom are still, and we've had this from surveys that we've done in some of our fintech companies, they have no other financial app on their phones, and this is what we can tell. 70-75% people have never used another financial app, whether it's lending or investment or so it's a very early stage of adoption, and that number is at least 300 to 400 million people.
How do you go about investing? Because you invested in some very interesting companies.
The market that we are talking about, and I'll use a particular example, if you take somebody like a KreditBee, right? So KreditBee is this lending platform, and if you go around, I think they're pretty popular now, right? If you look at somebody like KreditBee, right, you asked about is the market there in size, and ultimately the deeper question for the whole startup ecosystem is, can you fund somebody who can actually make money, right? Otherwise, there's no point in having size if you're going to blow investor money and then say after 5 years, hey, I've got 10 million customers, but I've got nothing to show for it, right? So if you take somebody like a KreditBee, what was very unique and tying everything together is the founder at KreditBee from day one understood what small ticket high frequency means, okay? Which means I cannot go in expecting that the average middle India consumer who makes between 3 lakhs and 20 lakhs a year in family income can afford to either spend enough to acquire the product, or I can spend thousands of rupees to acquire them as a customer. So the average loan size in KreditBee is about 10,000, 15,000 rupees. The cost for a bank to acquire a CASA account customer or a credit card customer is about 5,000 to 7,000 rupees. A KreditBee or a Jar acquires these customers between 150 to 300 rupees. Now, none of this would be possible without really having the digital rails you have in India, but also understanding the customer behavior of this segment in terms of how do I attract them to my platform without spending 7,000 rupees. So that's first point, how do you acquire them? But the second is somebody like a KreditBee, when we saw them, right, Shradha, they were doing about 75,000 loans a month, right? Today they do over 1 million loans a month, right? Wow. And they are profitable every month in terms of what they do, and they are the single largest profitable digital lender in India. KreditBee is a very, very profitable company. Advent, one of the largest private equity firms in the US, has invested in them because of that. But then the question is, is this just, do you just stumble across people like a Jar or a KreditBee? And we'd like to believe, no, there is a method to the madness, if you will, right? Yeah. And just like we talked about, a lot of these founders have a playbook in their head. And that playbook is, do I understand the psyche of this customer or this consumer, which many of them are from Middle India themselves, right? And second, have I now understood what business models actually tick? So we have found that when we speak to these founders, how do we find these founders? When we talk to them about Middle India markets, where we've done a lot of work, often they describe the problem and how they're going to go about doing it very differently at a level of depth and granularity. One is small ticket high frequency. Second, they talk about the importance of building trust with the customer, right? So if you take somebody like a Jai Kisan or even, Jumbo Tail, right? To get a Kirana store person to say, I'm just going to order through this app and the stuff magically appears and I'm going to transfer all my purchases to that, requires trust. How do you build that trust, the nuance behind that, right? So, and the third one that we have always found is, how do you essentially remove friction to adoption, right? So if you look at a Jar or you look at any of our other apps, you even talk about folks like Small Case, right? Or even a Smart Staff, making it very easy for the user to use the app after they have trust and they know they can buy it at sizes that they normally buy is crucial, otherwise you won't win. So we've got a certain playbook by which we assess these companies, and because we are thesis centric, we are able to spend all our time getting better at it.
I think the good news is that Middle India wants to experiment and find what will improve their lives, improve their livelihood. So the starting point is not a closed-minded, low-tech adoption, very mature level of customer adoption. It's a very high early mover, constituency in that it's young, they're tech savvy. So the default to start with is we will trust a service that's going to improve our lives. Yeah. Now it's for the service to either make it or screw it. Yeah. Right? If they don't mess up the customer trust, you're off to a very good start when you start addressing Middle India problems. That's something we've seen consistently across, that there is openness, and you don't have to be stamped, ISI mark service to actually go there and have doors open for you. It is if you're adding value to me, and that's also the value again of solving for non-discretionary spends, because people need it. They're not going to go by economic cycles. They will always spend. If it's going to make a difference in my life, I will pay for it.
What comes across is that you're also investing in entrepreneurs who are creating tangible impact. Is it also like an impact investment that you're making, or is it like any blue chip VC fund?
No, I think it is a function of the thesis. I think like Rahul kind of pointed out, if you think of the Indian pyramid, you just think of 1.1 billion people above the age of 11 in India. Okay, if you think of them, the top 90 million are in the, say, the top 100 million are in the top 20 metros. So it's 8 metros, then you throw in all the other cities, right? You throw in a Coimbatore, you throw in a Pune, you can throw in some of these other cities, right? After that, you've got 400, 500 million people, and 3 lakhs to 20 lakhs a year in family income is the middle class with some kind of disposable income in India, right? Below that, the bottom, 500, 700 million is truly NGO territory, right? So we are not there because it's still difficult to build business models where, as a VC funded company, you can return capital back to investors and yourself, etc., right? But the impact of going after Middle India, which is not already happening, is these are the people where you first have to get to have the trickle down effect from entrepreneurial activity, right?
Yeah.
So if you look at our companies, right, we don't have to go out and say that we are focused on impact for the bottom 700 million, but the middle 400 million, like in Jai Kisan's case, the average farmer who touches Jai Kisan is a marginal farmer with less than 1 acre property. All the, shall I say, people on the Smart Staff platform are people who on average make 20,000 rupees a month. That is, you're barely touching the 3 lakhs, right? Folks who are, for example, at KreditBee, which I've already told you. So we are able to track metrics. Our operating metrics often align very closely with the type of metrics you would actually want to see for the kind of impact startups are having on India. So that gives us a lot of satisfaction, gives founders satisfaction, gives us satisfaction, but we are still able to leverage the fact that digital innovation is creating this impact, but with business models where you can still make money, which then sustains itself.
Impact can only be created when it is needed. If somebody doesn't care so much, is going to make a marginal difference in my life, then you can't call it impact. So for example, I've subscribed to fancy grocery thing on my app. My gate didn't allow. I put the 6 to 8 a.m. slot. Of course, I was sleeping yesterday, so I didn't even know when they came. The phone rang and they went back. I checked again, I think last night or something, the order had been cancelled. The refund had been initiated because of my fault. The veggies came, the poor guys went back and it was my fault, but I'm getting a refund. And that's the top tier India. We are so spoiled for choice. And they know that for somebody ordering slightly premium price veggies, there aren't that many people in India, so they better give us. And whereas we have one more company which is doing e-commerce for farmers, for their input side. And I've heard the calls there. आपको मंदिर के पास जाके खड़े होना है in the middle of the afternoon because your package is arriving. The guy will go, he'll ask 20 times, where is my package? Because that's the nature of, how much scarcity there is, whereas in our case. So it can be called impact, but it's also what difference is it going to make in somebody's life.
And just a related point on that, because I think there's an aspect of this that is not consumer, that is small businesses, but we can come to that. But the related part of that we have discovered is digitization is also, removing traditional ways you think of segmentation. You think urban, rural. You think tier 1, tier 2, right? You think old versus young. But what is really happening, I think, with digitization is one of the largest segments in India is millennials. And a millennial, 50 kilometers outside Bhopal thinks very similar to a millennial sitting in Bangalore in terms of the apps they use, in terms of the social media they consume. So a lot of the smartest founders understand this. In their mind, the framework of what a middle India consumer is very evolved. And when you talk to them with your own understanding of what it takes to build a business, it all starts to click. So it's very fascinating.
What is the real tangible impact startups have brought in to the economy, to the people, to the large number of mass people that we have in our country?
To be very honest, I think the first decade, and Rahul's probably seen a lot of those. I mean, he's gone through 3 funds at Helion. He's seen the evolution of the Indian startup ecosystem with founders and startups. But if you ask me, with what is happening today, where digitization after 2015 is really spread across India, and founders are beginning to build models that touch more Indians, right? If you're only touching the top 50, 75, with some trickle down, your impact is restricted to that. But today, I think you're going to see over the next 10 years massive impact. I'll give you an example. We have a company we've invested in that provides VR-based headset training for mining workers. These are most blue-collar people who are driving an excavator in an open shaft mine in a Bihar or in Goa, somewhere, outskirts of Goa, where you're doing the excavation, right? Historically, the way they've been trained is you sit next to a person, you drive this massive truck, dangerous turns, and it's left up to you in terms of your safety and also the impact on the corporation in terms of efficiency, etc. Today, these people are snapping on an Oculus headset, and just like you see in a flight simulator, you see your mine, you're seeing what kind of turn you need to take, what's the speed at which you need to come down. And this is happening for thousands and thousands of workers in warehouses, in mines, in pharmaceutical companies. That is real impact, where technology is touching people, which before 2015 wouldn't have happened, because these people, the same technology they are used to, they're seeing it on their phone, they know how to use digital means of doing stuff. So that would be my answer, where sometimes timing has to be right.
What's the name of this company?
It's called Kasmat.
Very nice.
And they are doing it, I mean, there's a bunch of smart, very, very smart kids. They are from NIT Warangal, and they built an amazing piece of software. And this is now going into mines in Indonesia, it's going to mines in Malaysia.
Wow.
And so that's a direct example of how technology can transcend if the timing is right.
Yeah.
What Bala was saying, the first 10 years and after that, right? India was always this very slow moving molasses train in terms of what venture is doing. There was always this effort to marry tech with customer use case. And that was true because there was hardly any, I would say, customer side consumer opportunity because of lack of devices. You know, I remember looking at Wi-Fi hotspot companies, and then companies that were doing a phone plus one device, right, to do other stuff. You know, we've actually looked at a company that was thinking, this is all before Apple Android came and changed the whole, and I think from 2011 onwards, the consumer side pull has started. It's become a very exciting place to come. The 9 out of 10 real investment cases in India are execution plays. They are not really tech for tech's sake. It's like, how do we execute? And that's why more capital is needed upfront to show the trajectory. I mean, we were dealing with in the first 10 years with very linear growth cases, you know, trying to marry some kind of tech into an actually a restaurant business or actually a hair salon business. There was really no tech. But then you're growing one store after the other, and that was the VC story. But now you got non-linear growth.
Yeah. Where are you seeing the potential of building large-scale businesses?
See, the India opportunity, if you go back 20 years, hey, demographic dividend, there's so many young people in India, let's all go to India, right? So businesses have always tried to invest in India, and there have been different types of barriers always. First it was red tape, then it was the fact that even after you came to India, you figured out that it's not that easy to actually go do business in India. But what has changed in India, to Pramod's point, is like China invested in physical infrastructure, this digital infrastructure in India for the first time gives you that glimmer, more than a glimmer of hope, that you can actually maximize the potential of demand from these 400, 500 million people, right? But when you go ahead and you do that, you actually have a vast blue ocean. Just to use some jargon here, to tie it back to earlier in the discussion, when 40-50% of customers in a KreditBee, in a Jar, are all new to credit, you're not trying to get them to switch from somebody. There's nobody. So in areas like financial services, healthcare, food and agri, logistics, catering to Middle India, we actually believe that so many Flipkarts can be built because these are massive markets. Now, if you're going to take, hey, high-end fashion jewelry for the top 50 million Indians, that's a different segment in terms of AOVs. Here the scale is large, as long as you know how to build the right business models that we discussed earlier.
The underlying theme also that we're seeing in a lot of cases is aggregation of small ticket. The power of aggregation really is the defining theme for us. So I'll give you an example. In Jar, which is in digital gold saving, one of the product is gold leasing. So if you have 200 milligrams of gold, you can lease your gold. I couldn't, it's just beyond imagination that there is a realization from holding 200 milligrams of gold. There's a return on that. But it will not be possible unless another 10,000 people are putting their 200 milligrams together. Then it is of value to a potential leaser. As a leasee, you have no value with 200 mg. But when you're aggregated, that's when the power comes. And we're seeing this across the board. I mean, there's a company that uses agri-satellite data. Now we talk a lot about satellites generating farm images or any images. Who's going to use those images? Farmers need to use those images, but who's going to translate? This company is aggregating millions of these images through and making them usable by the farmer for agronomy advice, which is otherwise not usable at all. So I think the power of aggregating millions of users and then making a use case around it is obvious. It's very obvious, but when beginning to see use cases around it, it's fascinating.
What got you to come together?
Yeah, I think common meeting of the mind. I think at the end of the day, we were looking at what's going to change over the next, and is it something we want to do for the next 15, 20 years, and what we're working on needs to stand the test of time. So we weren't very sure, of course, with Middle India thesis. It looked like the things were coming into place. We went to the same undergrad, which is BITS, and I think we personally feel BITS kind of shapes you very uniquely. But yeah, I think that is a very common, that's a very strong binding for us, which is we think about a lot of things together. Stage of life, quite similar. I think we've lived in the US, we've come back to India, decade plus back, and we've really come back from global learnings, and I think view of the world is to see what we can do here in terms of venture.
For both of us, it also was an opportunity to try to build something unique and new that is based on a common belief, but also it's a brand new decade in venture in India, right? There are a lot of lessons and learnings in terms of how you build a platform, how you build an institution. I think he's gone through 3 funds. I've gone through a couple of startups and a fund. So I think there's also excitement around the possibilities of where India is going. It's not always about incremental difference. It's also can you really differentiate by thinking very different? And I think a thesis-led bet was just one, but we think this is a generational opportunity, and we are going to be able to do multiple.
And at a people level, I think we spoke to our founders that we had worked with in the past, and the feedback from Bala's founders was that he is the first port of call. And first port of call for me represents a board member who is, first of all, has the right advice for you at the right time, somebody you want to reach out to. From a founder, that validation is always very important. So I think our view in this fund, obviously, we want to be first port of call. We want to be there, available, etc. And we don't want to be people who just, are not the first guys that founders think about.
How do you see the VC space changing?
I think it's hopefully is going full circle, as most things do, which is it starts off from borrowing from the valley, what VC business is all about, which is, we are going to do it as a cottage industry. It was a cottage industry business. Few people would get together and try and make change through capital, and idea was to work with founders very closely. That 2-hour driving time is when you want to see your founders often enough to be able to figure out what's going on. And it was as much about finding companies as it was about helping build companies.
Yeah.
It was not only about, I think somewhere when the capital started chasing venture versus, venture raising, it is the most risky asset class, right? I think people tend to forget that. It is the most riskiest thing you can do. And if you don't have that square and center in front of you, that this is what you're doing, then things can go very wrong. So where it started going from 17, 18, I think we had the first cycle, there was a blip in 18, 19, then we picked up again because it was a continuous flow. There was really, it was just a pause, I think, in 19. And then 20 picked up like crazy, or, 21 was the craziest. It's just, it was a flow into the most riskiest asset class, assuming that it is going to give the highest alpha. What it then changed for the industry was it became a company picking business rather than a company building business. And what we are hopefully better at is doing both and more the company building part. So I think what will differentiate us and people who are going to work on building sustainable businesses is equal focus on both and not over indexing on finding. And then our thesis, our investment is always first check followed by multiple second checks, which means we are doubling down on our own bets. When we go into the market, we have a single check investor who's on a 20x. We have several companies on 20x, but we will always double down on our companies. Then, we're on a 5, 6x. Because the idea of venture is to return on more capital back rather than to show IRR or to show an X on your first check. On a 20 million, it's very easy to show a 10x, but on a 200 million, it's harder. On a 2 billion, it is even harder. So I think you want to figure out where you are on that curve, 20 billion to 2 billion as a fund size, and then what kind of return pressure are you willing to go through.
Started investing in 2020 and you've already invested in some very phenomenal businesses. And tell us, as of today, now you're launching your second fund, what does it mean? What will it do more than the first fund did?
So we've invested, Shradha, in 16 companies, and I won't name all 16, but we've talked about many of them. But in financial services, about 5 companies. We've done a couple in skilling. One was in the factory versus both factory, so staffing and factory training, if you will, right? And then we've done a couple in agri. We're doing one in manufacturing marketplace, which is again small businesses. We haven't talked a lot about it, but we really think that enabling small businesses with technology in India is going to play a big part to what the world is looking to India for, which is China plus one, as well as India being the supplier to the world. Every time you have a wave of companies, the next set of founders also learn what some of the challenges are. Like working capital is a big challenge, right? So some of these companies are beginning to find out large markets, but also figure out business models where working capital is a little easier, which then enables more small businesses to come on. We've done some of those. We've done one in healthcare. So that's kind of been our 16 company portfolio. We've
invested in 3 very different years. It could have been 3 different funds.
Yeah.
So that's the other thing. 2020 was like this complete opaque year where we had no idea. But it was still a very good year to invest because of the uncertainty. So we could get into some, very nice. So another way to look at it is venture is a risk buying business. We are buying into risk. Right? We can buy here or we can buy there based on what the market is pricing risk at. So 2020 was where we could buy into a lot lower risk companies at great prices. And that was where we pivoted more on the later stage. We want to do more pre-Bs at that point. And then because then the whole world woke up to venture, and 21 was a $40 billion a year. So everything became expensive. So it's like tomatoes right now. There is just a lot of capital chasing fewer companies in that year. So we had to then figure out what are we doing more. So it was a totally different year again. Just competing, losing deals left, right, and center. I mean, we left. I think January we started with 3 deals that we lost because of pricing. 2-3x more than what we thought was a very rich valuation. We lost that very quickly. Then we had to figure out, market's changing. Pricing is going to be a factor more than before. So then we had to factor in for the pricing, and then where do we pivot the risk? That was
sometimes I just think that we don't give enough credit to people like you, because you're entrepreneurs yourself. You're raising capital and investing in businesces. You are competing with people who can.
No, we are not playing golf all day.
I think that's true. But you don't get. Before we get into fund 2, though, I think the other thing that we have learned along the way, right, is like we started out, we've learned to crystallize in our own heads, how do you walk the talk of this thesis with our founders, right? So that attracts more founders to who are building for this. But the more things change, right, some things remain the same. Like I remember, from 2015 to today, you've built your story yourself, right? But the world around you has changed. The pace has changed. There is more money. You talked about more funding. Everybody is a VC. But in the trenches, right, day in, day out, I think what we find is the life of the founder doesn't change, because beyond money, what they really want is, hey, can you help me or can you work with me? See, help is a very strong word. Can you partner with me in figuring out the more complex questions that I'm dealing with in addition to just writing a check, right? So I think whether it is your go-to-market strategy, whether it is governance is a big thing right now, right? Whether it is your finance function. So I think where in addition, if you take our thesis and you take this foundational layer, we have really tried to build a lot of muscle around that, which is, I mean, we've talked about sales a lot, right? And I think that doesn't change. It doesn't matter how much money has come into the system, doesn't matter how fast the ecosystem has evolved, how much more expectations are there of the founder. At the end of the day, you have to build a business, and if we can support and partner with people with some past knowledge and take that seriously and really lead from the front, I think that's made a huge difference.
How do you compete? How do you view? Because it's also not easy for you to get the best of deals, but you've got those deals.
Yeah. And I think the nature of the business again is it's a cyclical business. So we can't, actually feel that this is how it's going to stay. We know that competition is going to come next year. Money will come and things will be back to 21. So we have to be prepared for, markets changing all the time. Because the venture cycles are predictable. If you're lucky, like I think we are raising now, we are in a lower cycle, and if you're super lucky, then we'll be exiting at a high cycle. Right? But if you're the other way around, then
which many are right
then these
now.
questions are going to be harder to answer. Which is you came in here, you're exiting here, and you can't predict really. You want to find out. But in terms of, I think, competing, it's certainly a market which has become more dense, as you were saying earlier. A lot of, and it's not just capital anymore, it's a lot about your own ethos, your thesis, and what you bring to the table for the founders. I'm seeing that, again, this was a obvious thing to expect to happen, but I think it's happening more and more, where founders want to know what are the personalities they will deal with, because, we have seen 10-year journeys from 2006 onwards, where we have had relationships with founders for 10 years. I mean, that's longer than a lot of marriages nowadays, right? So 10 years of being around the table, fighting or collaborating is actually something that needs you to have an eye to eye or conversation, or to have, a hug at the end of a fight. And it's a very collaborative process. So I think for us, it's a lot about, who's really understanding who are we working with, for them to understand who we are. And I think it is consistent behavior, more importantly from our part, where we are supportive. If we are supportive to founders, how are we supportive? What do we add value for? And then, thankfully in our venture ecosystem, there are now quite a few people who've seen down cycles as well as up cycles. 80% people, I would say, have only seen up cycles. And, they will have a hard time in this cycle more, because for them, this is a new thing. Both across the value chain, people have not seen down cycles. And that changes a lot of things. We preemptively were looking at, one thing which was very interesting is that there was so much rara and, just for the founders, which was, you can't do anything wrong, to a point where the founders got to, and it was an awkward stage to ask a tougher question. The founders were not prepared to answer tough questions from their investors.
They didn't even
it's not a thing, right? You can't. The preemption was that in this market, there are going to be harder and harder questions asked from you as a founder. So you better get into the mode of that. And starting with us, let's start getting you into that mode of where things are. So if you're going to, and that was a good 6-month, 9-month cycle, right? Where people were getting used to the idea of actually explaining their business models, or when cash is going to run out to their investors.
So what's the plan with the new fund?
The last one was 106. We're raising a $180 million fund. It will be a combination of about 70% foreign capital, 30% India capital, and roughly that much in institution versus non-institution. So our mix is very similar. We like the fact that there are institutional backers and there are large Indian family offices giving us the connects we need in India. And they're all coming from fundamental industries in India. They give us insights on how businesses are built here. And that thesis that we've talked about all this while is something we started off from a very fundamental concept when we did Fund 1. It was thesis pretty much. We believe now we have enough validation points, both from the growth rates as well as revenue model shaping up, where we're confident actually now that this is something we can double down on. So we do the same, more of the same. We do it in the same way. We have a long way to go. I mean, we take surveys from founders who we have worked with but not invested in to tell us where we went wrong in the evaluation process. And we have a long list of things that people complain about.
Oh, wow.
So we have to fix a lot of things. But as we do that, we can still see the opportunity. We can still address the opportunity. And that is, we can't stop raving about it. I think in terms of that limitless market opportunity, the founder who's lived the problem in a middle India household and then gone to a tech institute and thought of it as, how do I solve this at scale? That's a beautiful marriage, right?
Yeah.
You know the problem, you've been through it, and now you're solving it, thinking of how do I solve it at scale.
And if you wrap that whole thing up in the context of where India is today, the PM's visit and everything that you heard coming back about India, if India is that economy that is the largest economy growing at 6%, nothing else is available like that. But if you really think back about how is India going to do it, right? How are you going to live up to this potential of becoming a 9 trillion economy? This whole middle India piece has to work. The consumption has to be there. These people need to be supported by products and services from a new breed of companies. And also India's efficiency industrial-wise has to improve, which is going to come from these small businesses. And being kind of smack bang in the middle of that gives us a lot of, just excitement about where we're headed with it.
And some things I was, talking about conventional VC versus, so if you're doing 20 investments in a portfolio, which you plan to do in this as we did in the last one, we've remained pretty consistent in terms of how much capital we deploy per year. So whether it's 21 or 20 or 22, we've deployed about the same. So we just want to average it out over 3 years, not get driven so much by, as Bala was saying, the problems are there, we have to solve it, it's not getting changed, or success of a company outcome from a seed to an A is going to remain at 70% mortality, and it will not change. We have to work on the 30% in our portfolio to make sure that they're progressing. So I think those things will not change.
What has been some of your learnings, both professionally and personally?
For me, and it's a combination of professional and personal, right? They say, right, I mean, you don't know what you don't know.
Yeah.
Whenever I meet a company and a founder, especially after we have invested, I know I don't know, okay, which is you can never know more than the founder, not just in terms of because they live it day in and day out, right? And you also can sometimes rely too much on just like past experience is helpful, right? Sometimes you can paint every picture with the same brush just because you've seen it before. And I think what collectively also we have talked about this, we have found is our job is to guide and present the options and what's possible, but really listen very closely to what they are doing and support them and where they want to go, because ultimately we have backed them, right? But when that happens within the construct of our thesis, everything is just a bit more tighter, it's a bit more better, right? So that's point one. And point two, I think personally, I think it is a very unique opportunity to be an investor at this stage in India, especially with this whole middle India thing, because everything is new, everybody is figuring it out. It's not VC, it's not investing. Because, I mean, like the most recent company is investing in, I mean, it's combining satellite data with, agri inputs. But if it works, it really changes the way farmers make money. It changes the way produce gets on the table. It changes the way economics work in India. So there is this feeling that you're part of something bigger, right? And that then, and I'm not trying to wave the ESG flag, but I think there's a lot of impact in being part of what Arkam is doing, and I genuinely enjoy that. I think it makes you feel good coming into work every day.
Yeah.
My learning is that it's actually very easy to put out capital. So that part is, we used to celebrate and, so-and-so has raised so much capital and, we have invested, and for us that was like a climax, like wow, we've invested in something. Then you realize over time when you've been with companies for 6, 8, 10 years that you kind of have to watch this ball till the last boundary is reached or not reached, which is money in the bank.
Yeah.
And the industry curve has also moved with more family office participation to, from what started was a US endowment only participation, where cycles of exits were much longer, to family offices where 10 years is a long time, and they compare it to a public market investing. The pressure on exit or the expectation from exit is rightfully now in the market.
Yeah.
So I think the combination would be, some people would still think, hey, this is a great investing job. No, it's an exiting job. And that, I think, is again, how do you take this little company into becoming a exitable company of meaningful size? Obviously, you can exit anything at whatever price, but if you want to make money. And then the reality of a 4-5x on a fund, as you're saying, it's not an easy job at all. It's you have to find winners, and you have to catch cycles, of course. And Bala was he saying, I think I came across this term called Soshin, which is a Zen term, which is a beginner's mind. And it is about, you know so much, you can't be dogmatic about it. And that problem with the VC is, you can be bitter or negative or dogmatic. But you can't forget that, hey, this time it will be different.
Thank you.
Thank you.
Thanks so much.
Thank you.
Thank you.